Hey, it's Chris Goff, and in this training video, I want to share with you how you could save at least $40,000 on your next rehab. And you won't have to put a large down payment, pay high interest, 0 points, and pay less at closing. And I've been using this strategy for over 20 years. I wanted to share this training with you because I see a lot of investors that want to flip real estate and don't have the funds or credit to purchase these deals. If you do get financing from a bank, hard money lender, or even a private investor, this generally requires a large down payment, points, and high interest, or a combination of them. Even if you could get in with little to no money down, these lending institutions will get their money one way or the other. So today, I want to share a strategy where you don't need a third-party lending institution to fund the deal because you're going to get the seller to do it. It's a seller financing strategy called split funding. You can even share the profits with the seller. Usually this will get the seller's ears to perk up. I'm not saying you should, but it will help you get the deal. Now, this strategy won't work 100% of the time, but it's a great tool in your toolbox that will save you a lot of money, especially with higher priced properties. As I mentioned in the title of this video, save $40,000 on your next real estate flip. This is based on a $200,000 purchase price, which I'm getting ready to go into right now. So what is split funding? Split funding is a powerful financing technique because of the control it gives you. You will work with the split funding technique more than any other creative financing techniques. Split funding gives an investor the opportunity to get into a property with little cash up front, promising to pay the balance within 1 year. This gives the investor time to rehab the property and sell it at a retail price to a new consumer within the same time period. When you present your split funding offer to the seller, tell the seller that you could give him or her some cash today and the rest within 1 year. You can also tell the owner you could pay the balance within 6 months as long as the market is doing well. You do not want to short side yourself. Just make sure you have enough time to fix up the property and get it sold within the time you promised to pay the balance in full. Now, the money you put down to acquire the property can either be your cash, a credit line at your bank, maybe pull some cash off a credit card, or borrow the money from a friend. It really doesn't matter where you get the cash to put down, as long as you know you'll make a nice profit after all said and done. Once the property has been fixed up and sold to the new buyer, you will take the proceeds from the sale and pay the seller the balance you promised. Sellers will respond to this technique better because they will receive their agreed asking price within 6 to 12 month time frame, not 5 to 10 years down the road. So in general, instead of going to the bank, hard money lender, or using private investor, we are getting the seller to finance it for a short period of time. And by getting the seller to finance it, we can do the deal extremely fast. No long waiting time for loan approval and all the contingencies that come along with getting any kind of financing. So let's look at an example. So after running comparable sales and seeing what other similar properties have sold for, $325,000 would be our ARV. Next is repairs. So after viewing the property and calculating our rehab cost, we've determined that it would be $50,000. Acquisition cost is the closing cost when purchasing the property. And in this example, we are paying 100%. And this is great because as soon as you tell the owner that, they're more likely to do the deal. Now, these closing costs will vary depending on where you live in the country. And in most cases, it's going to be cheaper for you because you're not going to have all that paperwork that a bank or hard money lender would have to throw into closing. And this is going to keep your costs low. Holding costs are the costs you'll have during the rehab period, such as utilities, payments, and etc. Remember, you own the property at this point, meaning you have the deed. Closing costs are the costs associated with selling the property. So our goal is to fix up the home and resell it at a retail price. When this happens, you'll have closing costs, and I like to calculate this before I even make the offer because it's actual cost. And I see so many investors that don't do this, and when they sell, they can't figure out why they didn't make as much money that they thought. Hedge expense is a buffer of my estimated repair cost, which I calculate at 10%. This will give me some extra cash for those hidden problems you may incur while rehabbing the home. Agent commission is only paid when you sell the home because all real estate commissions are paid by the seller. Now, if you're not going to use an agent to sell the home, you can remove these costs, which will save you even more money. So my profit is generally calculated at 15% of the ARV. Now this number can change depending on how cheap you can get the deal. Once I have my ARV, I will subtract all expenses and my potential profit to arrive at my maximum offer, which is $211,000. Now, I don't want to start here, so I'll lower my offer. And keep in mind, at this point, I'm only calculating the purchase price. Now we need to set the terms. Now, everything you see in this presentation can be calculated in REIPro, from running comps and calculating the offer. If you're not a member of REIPro, you can start a free trial by clicking the link in the description below. So the seller accepted the $200,000 purchase price. We will put $5,000 down, and you could potentially get in with $0 down. But when you offer the seller some cash when they have a distressed property, they forget about the rest of the offer because money is the big motivator for sellers, especially cash in their pocket today. This brings our loan amount to $195,000. Now we want to get the interest rate low, and because the term is so short with the seller, they won't have a problem with this. This brings our monthly payment to $822.13. Now, we will be amortizing the loan over 30 years to keep the monthly payment as low as possible. Taxes and insurance are $1,000 per month, which you are responsible for because you own the property. I set the term of the loan at 10 months, which means even though we're amortizing it over 30 years, we have 10 months to cash the seller out. Now, you can set this term as short or as long as you want, and if the seller agrees. Now, from my standpoint, we aren't waiting for the 10 months to expire before we sell the property. I want this property to be rehabbed and sold as quickly as possible and before 10 months. We just want to give ourselves a little more time in case it doesn't sell quickly. So if we went the full 10 months, the balance for the seller would be $191,615.80. So let's look at split funding versus just traditional financing. You're going to save money just on the down payment. Most traditional financing, you're going to have to put at least 20% down. You're going to get a lower interest rate. There are no points because we're getting the seller to finance it, not Wells Fargo. There's also going to be lower closing costs because you're going to have a lot less paperwork at this particular closing because we're eliminating the bank. No bank approval, right? So we're not getting, hey, Mr. or Mrs. Banker, can you please give me a loan? No, we're actually structuring this with the owner. And no credit check. Now, some sellers could ask for a credit check, and I think that's okay. But at the end of the day, most sellers are not going to ask you for this. Your job as a real estate investor is to build that relationship. And when you build that relationship, you're going to build trust. And keep in mind, we're generally working with distressed properties in a motivated situation. As you can see, there are many benefits when you can get the seller to finance it short term. Now, not every seller will want to do this. This is just another tool in your toolbox and the one strategy I would love to do on every deal. Now, what happens if you can't sell the property within that time frame? You could refinance the property and you might be able to pull some extra cash out tax-free by doing it. You could try to extend the term with the seller. You could offer to split profits in order to extend the term. And if you do, I like to stick anywhere between 10 and 20%. Now, this could change depending on how profitable this particular deal is. So just keep in mind, our goal is to make this work. If you can't refinance it, try to extend the deal. That's going to be the most important part. And by extending the deal, you could technically actually split the profits with the seller. And if you even went into a deal like this and told the seller, hey, we're going to split the profits, I'm going to do all the work and take this property over, you might get a lot more deals every single year just by even offering this. I put together a video that teaches you another great seller financing strategy called subordination. You should go check that out because you're going to want to add some more tools to your arsenal. And before you go, click that subscribe button if you haven't already, and I'll see you on the next video.